Stop scrolling. Imagine you're walking down the street and you spot a discarded cigar butt lying on the wet pavement. It is soggy, it is disgusting, but it has just enough tobacco left for one last free puff. You pick it up, you take that one puff, and you throw it away. Was it a pleasant experience? Absolutely not. But hey, it was free, right? In the investment world. This is known as the cigar-butt strategy, and it is exactly how some of the most celebrated investors in history started their careers. But here is what those same investors eventually learned, often the hard way, and at enormous cost. Hunting for these cheap, dying bargains is actually a fatal trap. One that will systematically, quietly, and completely destroy your long-term wealth. Today, we are going to expose the cigar-butt trap in full detail. We are going to explore why buying mediocre assets at a discount is a far bigger mistake than most investors ever realize, why you absolutely need to shift your focus toward quality, and the exact mindset shift you must make if you are serious about capturing true generational wealth. I am the Wealth Guardian, and the mission of this channel is simple: to protect your wealth through education. We bridge the gap between complex financial concepts and practical real-world strategies you can actually use. If you are serious about keeping what you have worked so hard to build, please hit that like button right now, subscribe to the channel, and ring the bell notification so you never miss a video. And I want to encourage you genuinely to watch this one all the way to the very end, because the final concept I'm going to share with you today is a psychological trap called thumb-sucking. It is a subtle, almost invisible error that has cost even the most brilliant investors in history billions of dollars in missed opportunities. You do not want to miss it. Quick but important note before we dive in. Everything in this video is strictly for educational purposes. Nothing here constitutes legal or financial advice tailored to your personal situation. Please always consult a qualified professional for guidance specific to your circumstances. All right, let us get into it. To truly understand the cigar-butt trap, you first have to understand why bargain hunting feels so irresistible in the first place. Human beings are psychologically wired to love a discount. When you walk into a store and you see a TV marked down 50%, something lights up in your brain. You feel like you are winning. You feel smart. And that feeling is powerful. Early in his career, legendary investor Warren Buffett applied this exact same logic to buying businesses. He learned this method from his teacher at Columbia Business School, the father of value investing himself, Benjamin Graham. And the strategy was straightforward. Find a company the stock market has completely abandoned. Find a business so beaten down, so out of favor, that its stock is selling for less than the value of its working capital, meaning its current assets minus its current liabilities. In other words, the stock is so cheap that even if the company shut down tomorrow and sold off everything it owned, you would still walk away with more than you paid. It does not matter if the company is bleeding money. It does not matter if it operates in a dying industry. The thesis is simple. Buy in at a deep discount. Take that one last free puff of profit when the market momentarily corrects the price or the company eventually liquidates its assets, and then walk away. Quick, mechanical, transactional. Graham called these net investments. And in the right era, particularly during and after the Great Depression, when genuinely beaten down bargains were everywhere, it actually worked quite well. But as markets became more efficient and competition for these opportunities intensified, the strategy began to reveal its fatal weaknesses. And no story illustrates those weaknesses more powerfully than the story of Berkshire Hathaway itself. Back in 1962, Buffett began buying shares in Berkshire Hathaway, which at the time was a struggling textile manufacturing company based in New England. The textile industry was under enormous pressure. Cheap international competition was flooding the market. Profit margins were razor thin, and Berkshire's own operations had been steadily shrinking for years. The company had a track record of significant losses. By almost any measure, it was a business in serious trouble. But the stock was trading at around $7.50 per share, while its working capital alone was worth more than $10 per share. Classic, Graham-style bargain. Buffett bought in, fully intending to sell his shares back to the company at a profit once management initiated a stock buyback, a standard, clean cigar-butt exit. But then something went wrong. When management made their buyback offer, they tried to shortchange Buffett by a fraction of a cent, literally an eighth of a dollar per share below what they had verbally agreed to. Buffett was furious, and in a moment of pure emotion, rather than walking away with his small profit, he went out and bought a controlling stake in the company and took it over entirely. He had his bargain. But now he was permanently stuck with a fundamentally terrible business. The textile industry is what we call a capital-intensive commodity business. Every yard of fabric Berkshire produced was essentially identical to what a competitor in South Carolina, or increasingly, Asia could produce. There was no brand loyalty, no pricing power, no competitive edge, just endless price competition with no way to win. To keep the mills running, the business demanded constant reinvestment. New machinery, high electricity costs, maintenance, labor, and after all of that capital was poured back in, the returns were mediocre at best, and often outright losses. Buffett tried for nearly 20 years to make those textile operations work. He brought in good managers, he invested in equipment. Nothing worked. The economics of the business were simply broken, and no amount of managerial brilliance could fix that. It was through this painful 2-decade-long experience that Buffett arrived at one of his most important investing insights. He later put it this way: when a management team with a brilliant reputation takes on a business with a reputation for poor economics, it is the reputation of the business that remains intact. And he used another metaphor that I think is even more vivid. He said, if you find yourself in a chronically leaking boat, the energy you devote to changing vessels is likely to be far more productive than the energy you devote to patching the leaks. That is the cigar-butt trap in its purest form. You find yourself so focused on the cheapness of the asset that you completely ignore the fundamental question, is this actually a good business? And by the time you realize it is not, you are already ankle-deep in water, bailing frantically, burning your time, your capital, and your mental energy, resources you could have been deploying towards something genuinely wonderful. Berkshire Hathaway was not the only lesson Buffett needed on this front either. In 1966, through one of his early investment partnerships, Buffett purchased a Baltimore-based department store called Hochschild Kohn, again purely because it was available at a meaningful discount to its book value. On paper, it looked like a bargain. In reality, it was another fundamentally weak business. Retail is brutally competitive. Department stores operate on incredibly thin margins, face constant pressure from new competitors, and require heavy ongoing investment in inventory and store maintenance. There was no durable edge, no pricing power, no moat. It was a tough business in a tough industry, purchased purely because the price was low. Buffett eventually sold Hochschild Kohn, and he was fortunate to get out at roughly the same price he paid, which in the world of investing is practically a loss once you account for the opportunity cost of that capital sitting idle. His longtime business partner, Charlie Munger, later reflected on that purchase and put it brilliantly. He compared buying that department store to buying a yacht. The two happiest days, he said, are the day you buy it and the day you sell it. Everything in between is just expensive headache. That line is funny, but the lesson underneath it is deadly serious. Acquiring any asset, a stock, a property, a business, solely because the price looks low without any genuine analysis of its underlying quality and long-term prospects is not investing. It is speculation dressed up in the language of value. Let me stop here for a second and ask you something directly. Have you ever bought an investment, a piece of real estate, a stock, a small business, simply because it was cheap, and then discovered over time that the constant repairs, the hidden costs, the headaches, and the management time made it a genuinely terrible deal? Drop that story in the comments right now. I read every single comment on this channel, and your experience might be exactly the warning sign that saves someone else from making the same mistake. Let us get a real conversation going down there. So if hunting for cheap, mediocre businesses destroys wealth, what is the alternative? The alternative. The insight that transformed Buffett from a good investor into the greatest investor in history is this: time is the friend of the wonderful business and the absolute enemy of the mediocre one. Think about what that means in practice. A mediocre business, one without a real competitive advantage, earns mediocre returns year after year. Inflation erodes the purchasing power of those weak returns. Competition slowly chips away at market share. Management has to run harder and harder just to stay in place. The longer you hold it, the more value it destroys. But a wonderful business compounds. Every year it generates strong returns, reinvests those returns into expanding its competitive position, and becomes more valuable, more dominant, more defensible. The longer you hold it, the more that compounding snowball rolls, and the bigger it gets. So what makes a business truly wonderful? It comes down to one core concept: a durable competitive advantage. What Buffett calls an economic moat. A wonderful business is one that does not have to compete purely on price. It does not operate in an undifferentiated commodity market, where the only way to win customers is to slash your margin. Instead, it possesses real lasting advantages. This might be an iconic brand that commands premium pricing and fierce consumer loyalty. It might be a network effect, where the product becomes more valuable as more people use it. It might be high switching costs that make it genuinely painful for customers to leave. It might be proprietary technology, regulatory licenses, or cost advantages that competitors simply cannot replicate. These businesses can raise prices without losing customers. They generate strong, reliable cash flows. They require relatively little reinvestment to maintain their position, and crucially, they can be understood. You can look at what makes them special today and have reasonable confidence that those same advantages will still be in place 5, 10, 20 years from now. But here's where investors make their second massive mistake. Even when they correctly identify a wonderful business, they treat it like a cigar butt. They sell far too soon. Take the Walt Disney Company as the perfect example. Back in 1966, Buffett recognized Disney as an extraordinary business. Think about what Disney had at that time: an irreplaceable library of animated films that could be re-released to new generations of children every few years at virtually zero additional cost. A theme park in California that was already generating remarkable returns. A brand so powerful that parents all over the world would willingly pay premium prices to give their children a Disney experience. And a founder, Walt Disney himself, whose creative vision had built something genuinely unique. The pricing power was exceptional. The brand loyalty was fierce. The business had multiple revenue streams that reinforced one another. Buffett purchased approximately 5% of Disney for around $4 million, and then, in what he has since called one of the most painful mistakes of his investing life, he sold that stake less than a year later to pocket a roughly 50% gain. 50% in under a year sounds great, but consider this. Disney went on to become one of the most valuable entertainment companies on Earth. That original $4 million stake, held and compounded over the following decades, would have grown to be worth billions of dollars, and that is before accounting for the dividends paid out along the way. Buffett knew Disney was a wonderful business. He understood it deeply. He just did not yet fully appreciate the single most powerful force in wealth creation, the magic of long-term compounding in a truly great business. He was still thinking like a cigar-butt trader: get in cheap, get out with a profit, move on to the next one. When in reality, with a wonderful business, the right move is almost always to do nothing. Buy it, understand it, and let time do the heavy lifting. This is a lesson he internalized deeply after Disney, and it fundamentally changed the way Berkshire Hathaway invested going forward. Which brings us to the final trap. And in some ways, this one is the most dangerous of all, because it is the one that is hardest to see in yourself. Charlie Munger called it thumb-sucking. Thumb-sucking is not an error of action. It is an error of omission. It is not about what you do wrong, it is about what you fail to do at all. Here is how it happens. You identify a wonderful business. You understand exactly what it does and why it is exceptional. You can see clearly that it has a powerful competitive advantage, strong financials, and a genuinely bright future. Maybe you use the product every single day. Maybe you have watched the company grow for years and you admire everything about how it operates. But then you look at the stock price, and it has moved up 10% since you first started paying attention, or 20%. And instead of buying, you hesitate. You think, I will wait for it to pull back a little. I will wait for a better entry point. The price was lower 6 months ago, so surely it will come back down. And you sit there, figuratively sucking your thumb, waiting for a price that may never come, while the business continues to compound, continues to grow, continues to create extraordinary value for the people who had the conviction to act. We see this pattern repeated constantly among investors who absolutely know better. They understand the business. They believe in the industry. They can articulate exactly why the competitive advantage is durable. And yet they wait. They wait for the bargain hunter's discount. They wait for the price that feels comfortable. And while they wait, the window closes. The tragedy of thumb-sucking is that conventional accounting never records its cost. If you make a bad investment, you can see the loss on your brokerage statement. But if you fail to make a great investment because you were waiting for a lower price, that cost is invisible. No statement shows you what you would have had. No spreadsheet captures the compounding returns you missed. The loss is completely hidden. But it is absolutely real. And over a lifetime of investing, those missed opportunities are often far more expensive than any actual mistake you ever made. Munger was direct about this. He pointed out that in a long investing career, you will encounter only a handful of truly obvious high-conviction opportunities. He called them no-brainers. And when those opportunities arrive, you must have both the clarity to recognize them and the courage to act decisively and in size. Waiting for a slightly better price on a no-brainer opportunity is one of the most expensive habits an investor can have. So let us bring all of this together into a clear framework you can actually use. The cigar butt trap begins with the seductive logic of the bargain. A cheap price feels like safety. It feels like margin of protection. And in the short run, it might even produce a quick profit. But over the long run, cheap, mediocre businesses destroy capital, consume mental energy, and distract you from the opportunities that actually matter. The antidote is a fundamental shift in how you think about investing. You're not looking for the cheapest asset. You're looking for the best business, one with a durable, competitive moat, strong and consistent earnings power, pricing authority in its market, and a track record that gives you genuine confidence in its future. When you find that business, you pay a fair price for it. Not necessarily a bargain bin price, a fair price. Because as Buffett has said so clearly, it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The quality of what you own matters infinitely more than the precise entry point. And then, this is the part that feels counterintuitive but is absolutely critical. You sit on your hands and let compounding do its work. You do not sell because the price went up 50%. You do not sell because the market gets nervous for a quarter. You hold because time is the friend of the wonderful business, and every year you hold a truly great compounding machine, it becomes more valuable. Finally, when you encounter those rare, clear, high-conviction opportunities, do not suck your thumb. Do not anchor to yesterday's price. Recognize what you have found. Act with appropriate conviction and trust the analysis you have already done. I want to hear from you before we close out. Are you guilty of thumb-sucking? Is there a company you have been watching for 1 year, 2 years, maybe longer, a business you genuinely understand and believe in, but you have been holding back, waiting for the price to come back down just a little bit? Tell me in the comments. No judgment here. This is one of the most common and most costly mistakes investors make, and naming it out loud is often the first step to breaking the habit. To build true, multi-generational wealth, you have to be willing to let go of the thrill of the bargain hunt. Stop searching the clearance bin for the cheapest, most beaten-down assets hoping for a quick flip. That is trading, not investing. And the difference between those two activities, compounded over decades, is the difference between financial struggle and financial freedom. Remember the principle that ties all of this together. Price is what you pay, and value is what you get. Demand durable, competitive advantages. Demand businesses with genuine earnings power and strong reinvestment economics. And when you find that rare, wonderful business, do not wait for it to go on sale. Act decisively, buy it at a fair price, and then let time work its compounding magic on your behalf. That is how real wealth is built. Not through 1,000 clever trades, through a handful of exceptional decisions held with patience and conviction for a very long time. If you found value in this video and you are committed to protecting and growing your financial legacy, please hit that like button, subscribe to the channel, and ring the bell notification so you never miss our weekly wealth protection content. And remember, building wealth is hard, but keeping it is harder. Long-term financial security belongs to those who plan carefully, think clearly, and absolutely refuse to settle for mediocre assets. Stay prepared, stay protected, and I will see you in the next video.